Investing used to be for the wealthy. You needed lots of money and a fancy financial advisor. Not anymore. Crowdfunding has changed the game. Now, everyday people can invest in startups and small businesses. It's like a big group of friends pooling money together. But instead of buying a boat, you're investing in someone's dream. It's exciting and potentially profitable, but you need to be careful. Crowdfunding has exploded in popularity. People are looking for new ways to grow their money. They're also drawn to the idea of supporting entrepreneurs directly. But remember, investing always comes with risks. Before you jump in, it's important to understand how crowdfunding works and the potential pitfalls. Let's break down how crowdfunding actually works. It's pretty simple. A company or individual pitches their idea on a crowdfunding platform. They set a fundraising goal. Investors, like you and me, can browse different projects. If something catches our eye, we can contribute money. The amount you invest can be small or large, depending on the platform and your budget. If the project reaches its fundraising goal within the time limit, the money is collected from the investors. The company then uses the funds to bring their idea to life. But if the project falls short of its goal, the money is usually returned to the investors. It's an all-or-nothing system in most cases. Crowdfunding isn't one-size-fits-all. It's a versatile tool that can be tailored to fit a variety of needs and objectives. Whether you're an entrepreneur looking to launch a new product, a nonprofit seeking donations for a cause, or an individual with a creative project, there's a crowdfunding model that can work for you. There are different types to suit different goals. Each type of crowdfunding has its own unique set of benefits and challenges, making it important to choose the right one for your specific situation. Let's talk about the most common ones: donation-based, equity-based, and lending-based. Each of these models serves a different purpose and attracts different types of backers. Donation-based is exactly what it sounds like. It's a straightforward way to raise funds for a cause or project without offering any financial return to the donors. You give money to a cause or project you believe in, without expecting anything in return. This model is often used by nonprofits, charities, and individuals looking to fund personal causes or community projects. It's like donating to charity. The primary motivation for donors is to support a cause they care about, rather than to receive a financial return. Equity-based crowdfunding is more like buying stock. This model allows backers to invest in a company in exchange for equity or ownership shares. You invest in a company in exchange for a share of ownership. This can be an attractive option for startups and small businesses looking to raise capital without taking on debt. If the company succeeds, your investment grows in value. However, it's important to remember that with potential high rewards come high risks. Not all startups succeed, and you could lose your investment. Lending-based crowdfunding is like being the bank. In this model, you lend money to a business or individual with the expectation of being repaid with interest. You lend money to a business or individual, and they pay you back with interest. This can be a good option for those looking for a more predictable return on their investment. It's like making a loan to a friend, but with a formal agreement. The terms of the loan, including the interest rate and repayment schedule, are clearly defined from the start. Understanding the differences is crucial. Each type of crowdfunding has its own set of rules, benefits, and risks, and it's important to choose the one that best aligns with your goals and risk tolerance. It helps you choose the type of crowdfunding that aligns with your financial goals and risk tolerance. By understanding the nuances of each model, you can make an informed decision and increase your chances of success. Donation-based crowdfunding is about supporting something you're passionate about. It might be a local artist's album, a documentary film, or a community garden. This type of crowdfunding is less about financial returns and more about making a difference. You won't get any money back, but you'll feel good knowing you helped make something happen. Many people use donation-based crowdfunding for personal causes like medical expenses or disaster relief. It's a way to rally support from friends, family, and even strangers. While it's wonderful to support worthy causes, remember that donations are not investments. Don't expect a financial return. Give from the heart, not your wallet's expectations. Section 5. Equity-based crowdfunding, owning a piece of the pie. Now let's talk about equity-based crowdfunding. This is the type that gets people excited about potential profits. You're investing in early-stage companies. Imagine investing in the next Google or Amazon before they were household names. That's the allure of equity crowdfunding. You could be part of something big. But here's the catch. It's risky. Most startups don't become the next big thing. Many fail. You could lose your entire investment. However, if the company you invest in takes off, the returns can be substantial. Your small investment could turn into a significant amount of money. Section 6. The rewards of crowdfunding, accessibility and beyond. Crowdfunding has opened doors for investors of all levels. You don't need to be wealthy to participate. Even with a small amount, you can diversify your portfolio. Previously, investing in startups was limited to venture capitalists and angel investors. Crowdfunding has democratized access to these potentially lucrative opportunities. Another benefit is the potential for high returns. Early-stage companies, if successful, can generate significant profits for early investors. Moreover, crowdfunding allows you to support businesses and ideas you believe in. It's a way to put your money where your values are. Section 7. The risks, what you need to know. While crowdfunding offers exciting opportunities, it's crucial to be aware of the risks. Crowdfunding can democratize investment, allowing everyday people to support innovative ideas and startups. However, this accessibility comes with its own set of challenges and potential pitfalls. Like any investment, there's always the potential to lose money. The market can be unpredictable, and even the most promising ventures can fail. It's important to understand that investing in startups is not a guaranteed path to wealth. One significant risk is fraud. With the rise of online platforms, it's easier than ever for scammers to create fake campaigns. These fraudulent activities can be sophisticated, making it difficult to distinguish between legitimate and fake opportunities. Unfortunately, some crowdfunding campaigns are scams. They might promise high returns with little to no risk, which should be a red flag for any investor. Always be skeptical of offers that seem too good to be true. Do your due diligence before investing your hard-earned money. Research the campaign thoroughly, check the credibility of the team behind it, and look for reviews or feedback from other investors. This can help you avoid falling victim to fraudulent schemes. Another risk is lack of liquidity. Unlike stocks traded on public exchanges, investments in private companies are not easily sold. This means you might not be able to access your money when you need it. It's not always easy to sell your investment in a private company. You might have to wait for a long time before you can find a buyer, or you might have to sell at a loss if you need the cash urgently. You might be stuck with it for a while, even if you need the cash. This can be particularly challenging if you face unexpected financial difficulties and need to liquidate your assets quickly. Additionally, investing in early-stage companies is inherently risky. Many startups fail. Despite having a great idea or product, they might not be able to execute their business plan effectively or secure additional funding. Be prepared to lose your entire investment. It's essential to only invest money that you can afford to lose without it affecting your financial stability. Before investing in any crowdfunding opportunity, thoroughly research the company, the team, and the market. Look at their track record, their business model, and their growth potential. Understanding these factors can help you make a more informed decision. Don't let excitement cloud your judgment. While the prospect of high returns can be enticing, it's important to remain objective and cautious. Always weigh the potential rewards against the risks involved. Section 8. Tips for smart crowdfunding. Here are some practical tips for navigating the world of crowdfunding investments. First, do your homework. This means diving deep into the details of the project you're considering. Understand the market it operates in, the problem it aims to solve, and the potential for growth. Research the platform, the company, and the founders. Look into their backgrounds, their track records, and their vision for the future. A strong, experienced team can make a significant difference in the success of a project. Look for red flags and verify information. Be wary of overly optimistic projections and promises that seem too good to be true. Cross-check facts and figures with reliable sources. Second, invest only what you can afford to lose. Crowdfunding is risky. It's important to remember that not all projects will succeed, and some may fail completely. Don't put your rent money or emergency fund on the line. Third, diversify your investments. By spreading your investments across multiple projects, you reduce the risk of losing everything if one project fails. Don't put all your eggs in one basket. Diversification is key to managing risk in any investment strategy. Spread your risk by investing in multiple projects across different sectors. Fourth, be patient. Understand that crowdfunding is not a get-rich-quick scheme. Crowdfunding is a long-term game. It often takes years for companies to grow and generate returns. Don't expect to get rich quick. Be prepared for the long haul and set realistic expectations for your returns. It takes time for companies to grow and generate returns. And finally, stay informed. Regularly check in on the progress of your investments. Keep up with the progress of your investments. Read updates from the companies and monitor the crowdfunding platform. Staying informed will help you make better decisions and adjust your strategy as needed. By following these tips, you can navigate the world of crowdfunding with greater confidence and increase your chances of success. Section 9. Conclusion: invest wisely. Crowdfunding is a powerful tool that can democratize investing and support innovation. It offers exciting opportunities for investors of all levels, but like any investment, it comes with risks. Before you jump in, educate yourself, do your research, and invest responsibly. Remember, don't let the fear of missing out cloud your judgment. Approach crowdfunding with a cautious and informed mindset. Invest wisely, and you might just reap the rewards.